All right, everybody, welcome back. Real World Retirement, the podcast, the YouTube, all the fun stuff. I am your host, Alexander Pushman, and I'm really excited for today. Now, if you've been on the journey with us before and you've seen some past episodes, our whole goal is to bring real world stories from families and clients that we've worked with in the financial industry and help maybe round some corners for you, give you some education to help you not hit those same pitfalls that some of these other families we've worked with. Now, to give you a little bit of background, Foguth Financial Group is the firm that we all work for and service, love, and work into. And our main priority is bringing peace and purpose to people's money and finances. Okay, that's our mission statement. That's everything we do. Now, a little bit about myself. I've been in the business and the industry for over a decade. I've done a little over 3,000 second opinions now. So, after you do something a couple thousand times, you kind of see the trends, you learn from experience. So me personally, I love what I do. I got into this from a family business. However, today you are in for a real treat. The episode or the main points, the key takeaways, all that fun stuff today's episode is going to be measuring risk. So who better than one of our senior advisors, our lead advisor in Troy, Ken Voog. So Ken, thank you for coming on today.
I appreciate it.
Absolutely. I'm excited. So there may be no better guy to talk about this. One of the things specific to Troy that's a little bit different is you guys deal with a lot of high net worth families.
Almost exclusively.
Yes. Yep. And in those high net worth scenarios, of course, investment choice is important.
Absolutely.
Of course, taxes is important.
Always.
But a lot of the times, and you've really been good with, I'd say educating the team on this, is sometimes you don't have to take as much risk.
Most of the times you don't, especially with high net worth individuals. Yeah. But knowing how much risk you're actually taking is what's most important to start with.
Yeah. So when we go through risk, we're going to break it down into three categories. Sure. Ken gave me a really good outline here, so he's got this thing ready to go. The first thing we want to do is we want to break down, hey, what is a risk spectrum? And how can you identify where you are on that risk spectrum? The second thing we're going to jump into is, okay, now we've identified this risk spectrum. Where are you at on that risk spectrum today? And does it match your risk tolerance? Third piece we're going to talk about is kind of that transition to retirement. Hey, I'm retiring or I'm about to retire. What type of adjustments do I need to make to adopt my investments to match that risk tolerance to give me that peace of mind? So, before we kind of keep getting into it, do me a favor. I always like to ask Ken, why do you do what you do? What got you into the business?
I've been in over a decade as well. I've had a couple of different jobs doing everything within wealth management, but a couple of different experiences that have really gotten me to where we are today.
Right.
But I've always been interested in investments and finance. I remember when I was a kid, do you remember having a bank book? Where they actually wrote in their balances, right? And you can't just see it on the computer.
Yes,
so
I do.
I would ride my bike up to the bank because I couldn't believe that they would give you interest just for having money with them. It was like free money to me. I couldn't believe it. So that was what really piqued my interest early on. But I remember, when I was probably 8 or 9 years old, my grandfather, he was always big in investing, and he bought me a book. It was called Money Sense. I think it was CENTS. I still can't find it, but when I got that book, I probably read that thing, 6, 7, 8 times.
No kidding.
Yeah, but it was tailored towards, an adolescent.
Okay.
To teach them the very basics about investing, and for some reason, it just stuck with me. So, after reading that several times, just getting interest in a bank account, that wasn't enough. Right now, I want to try stocks. I want to start figuring some of this out. And I started doing some of my own research, and this is kind of a funny story, and I think takes me to where we are today.
Yeah.
But started doing my own research. This is probably 2000.
Okay.
Great time to start investing.
Oh, baby, let's go.
So I wanted to buy my first stock, and I think I had about $90 saved, right, in the bank account. I said, all right, we're going to try buying a stock. And I remember I bought this stock. It was called PSI Net, technology company, obviously, at that time. And every day I would get the newspaper and I would see where it was at, right, and just start tracking it. And after 2000, what happened? Dot-com bubble. And I remember a couple of years later, I got a letter. It was from Merrill Lynch, right? Because that's where the account was at the time. And they said, we are closing your account because it is deemed worthless. I remember they used those words, and that stuck with me.
Yeah.
right? Because that was all I had at the time.
That was your first experience.
Exactly.
Yeah.
So that, I think, really started to show me the level of risk that you should take, right? Because at that time, you can risk losing $90.
Absolutely.
But as you get older, right, as you're nearing retirement, you can't start losing all of your money. So, but that was really a big experience for me, and it's just always been with me. Investing, economics, I've always loved it. It's what I went to school for, et cetera.
So that's interesting. And what's funny about it is I bet there's a lot of folks out there listening or watching right now who you were just pinging some memory banks that they probably forgot about.
Yep.
You go to the bank and it's like, your bank book.
Oh, yeah.
Right?
Yeah.
When you're doing the stocks, it was just a different world, right? Like I still have clients to this day. They'll bring in the physical stocks or the bonds. I just saw it a couple days ago. But you know what I mean? We're just kind of going back in and one quick reminder, if you've enjoyed this and you're one of those folks who enjoy listening and learning and the educational piece, please make sure you're following our channel, you're subscribing, whether, again, that be on YouTube, the podcast channel. Please make sure you're engaging with us. And throughout the podcast, there's going to be some things I know that Ken say or I may say that you're like, wait a minute, I need to know more about that. I have questions about that. Is that me? Please do not hesitate to drop us a line. Send us an email. Send us a message on social media. Whatever it is, we will get back to you, and we're happy to answer those type of questions. So, been into it forever.
Yes.
And that's really interesting. I really want to go try to find that book.
Me too. I've tried to find it for some reason.
And what was the name of it again?
Money Sense.
Money Sense.
Yeah.
CENTS.
I believe it was CENTS. Yes, and it was tailored towards an adolescent. Right?
I'm going to tell Mike to find it. He's like a detective. Sure he'll find anything. So anyway, tell me a little bit about the story, because I know you had specifically thought of a specific family that you had met with, did a second opinion with. That made you think of this measuring risk conversation.
No, absolutely. Because measuring risk is important, and I think it's a little more complex than what most people will realize, right? Generally, when we talk about risk as a financial advisor, just taking it as simple as we can, we're really talking about an allocation between what? Stocks, bonds, cash, right? To keep it pretty simple. But it can get a lot more complex than that. And some people are taking a lot more or a lot less risk than they actually think they're taking.
Correct.
And that can be for a bunch of different reasons, right? Different mutual funds can have different mandates on what level of risk they're taking. Some people just don't know what they own, right? So just educating people on that is important. I remember just a couple of weeks ago, I had a couple come in and we sat down, we're having a good discussion, right? And the topic of risk started coming up. And I asked how much risk they're willing to take with their accounts, right? They're a high net worth family. They live below their means. They really don't need to take a lot of risk. And they told me that they're not willing to take any risk.
Interesting.
Okay? Yes. No risk.
Yes.
And we have a great meeting. They come back in, before they come back in, they send me over their statements. And let me tell you, they're not taking no risk. Okay. Right. It didn't even take some of the analysis that we're able to do to determine how much they're taking. You could see it, right? They were in about 80% equities. And when you're looking at that from an overall allocation perspective, that'd be considered aggressive.
Yeah. 7, 8 out of 10 based on the holdings. Right. Absolutely.
Right. And they weren't even aware.
Right.
And it wasn't because they were unintelligent by any means. They just weren't educated on the fact. So
that's interesting. So, and just to give a little bit of context for the folks that are listening, because to your point, we're talking about, hey, somebody says no risk, right? Then we're usually going to dial in and say, okay, are you a 0?
Right.
Are you a 1? Are you 2? So what am I talking about? There's usually 2 levels of risk, and again, Ken, jump in and interrupt me. But usually people are going to use 1 or 2 spectrums of risk. The first one is going to be a 0 to 10 scale. Hey, 0, I want no risk, right? I'm okay taking less interest, but no risk, 0 out of 10. Or you're a 10 out of 10. Hey, I'm okay with all the risk in the world. Go ahead, throw my money into all the cryptocurrencies you can handle, right? And kind of joking, but crypto would be considered a high risk investment, right? So most of the time, people are going to fall somewhere in between these 2 lines, or people use a 0 to 100 scale. Same conversation. You're just using 0 to 100, right?
And really for them, it was just about protecting their principal, right? They felt that they had worked for so long. This is a couple that was in their 60s, and they're retired now. They're not willing to risk anything that they've spent saving for the last 40 years.
Right.
which I would put as about a 0.
Yeah.
If you're not willing to risk that principal, then, and you're a very conservative investor, and there's nothing wrong with that.
Yeah.
If you don't need to be taking any of that market risk.
Absolutely. And so let's kind of back up, because to your point, they're saying, hey, I want no risk. You get the statement to do your job and analyze, hey, I'm going to look at fees. I'm going to look at holdings. I'm going to look at risk, which is what we're talking about today. You get it, and you realize, wait a minute, you're probably closer to an 8 out of 10.
Yeah.
You're taking a ton of different risk. Talk me through what that education process looks like, that conversation with the family to help them understand, hey, where am I at, and kind of be able to actually make sense of it.
Yeah, it depends on each individual person, right? We all have different levels of education with which we were brought up in finance or what we've learned over time. Excuse me. So understanding where their current education stands really starts in the educational process that I'm able to offer to our clients. Right. They unfortunately just weren't very well educated on the different kinds of investments and the different levels of risk that each investment took. So it really just started with a very basic understanding of the difference between the levels of risk and the different types of investments that were available to them.
Right.
So we were able to start going through that process, right? I consider education to be one of the most important things that we do.
Amen.
And the education started with determining what type of investments would really make the most sense for them.
Okay, so more or less what you're doing is you're saying, listen, I understand you're here. This is where you want to be.
Right.
To your point.
Right.
But you're here. So maybe not necessarily, and I know you've talked about it a little bit, but you explain what they're in, but then you start breaking down, hey, these would maybe be more suitable investments.
Right.
And walking down the educational path of, hey, these are the investments that are going to suit that no risk to minimal risk principal protection concept.
Correct. And it's not that they were necessarily in the wrong investments, but they were in the wrong investments for the time.
Amen.
Right?
Right. Great point.
Because 10 years ago, when they were in this 80% equity portfolio, that might have made sense, right? They were still working. They still had a little bit more time to allow the investments to grow. But now as they had transitioned into retirement, we need to start thinking about how the investments need to change for the level of risk that now you're willing to take.
Yeah.
Right. And I see a lot of times where that isn't updated properly as people transition into retirement.
Right. And not to throw shade at our business, but I tend to do that sometimes, is you got to look at it from, like, if I'm sitting here and I'm the consumer, right? And you know this as well as I, right? Is, financial advisors are people.
Right.
People make mistakes.
Absolutely.
Some people have great work ethic. Some people are lazy. Right. And one of the things I always talk about in the financial space, good, bad, and different, we get paid. And I've said this before, we get paid whether the market goes up or down.
Right.
And you get somebody who might be, and I'm not saying this is always the case, you get somebody who's been in the business for a long time. They're pretty set. They're, quote unquote, fat and happy. And they don't really have to do anything to get the exact same paycheck.
Right.
Right. And I'm not saying that's anybody or all people or anything. All I'm saying is it exists.
Oh, yeah.
And if you're sitting there looking at your statements and you never see any transactions and you don't see any adjustments, and it's 10 years later, you might want to get a second opinion.
Absolutely. And that just comes down to communication and knowing your client.
Absolutely.
Right. And that's why I think it's so important to have active participation from your clients and people that you're working with to be able to make sure that you know all the relevant information and can update things as their life changes as well.
Correct. So now take me to, all right, you identified where they were at. They were lower, no risk basically. Hey, we don't want any risk. You identify, hey, you're actually up here in the opposite side of the spectrum.
Right.
You educated them on what their options were to be in that spot. What did that process look like pertaining to, maybe questions they asked, concerns they had? Because again, we're creatures of habit. I know that a lot of people sometimes get nervous about making changes.
Oh, absolutely. I mean, that's one of the hardest things for us to do.
Right.
But again, that comes back to education. So it's really just to show them, and this can get more into the math of it, but what the actual expected return is with their allocation, and then what the standard deviation is as well.
Right.
Because just because you have a higher expected rate of return, I mean, that means you're taking more risk, so your standard deviation is going to be higher too.
Right.
But you may not need that to reach your actual goals in retirement.
Yeah. Right? Do you mind breaking down standard deviation?
So standard deviation. Anybody ever remember taking a stats class? Right. Remember that? Yeah, probably one of my favorites and probably one of most people's least favorites.
Right.
But you have an average. Let's say you have your mean, your average return of 5%. And then you have a standard deviation of, let's just say, 10%.
Okay.
right? So if you're one standard deviation off the mean, right, 5% plus 10 would be what? 15%.
Yep.
And what's 5 minus 10?
5.
5. Good. Nicely done. So that is one standard deviation. And if you remember that bell curve, one standard deviation will happen about 65% of the time. Okay. So you can expect your return to be -5 or +15, 65% of the time.
Got it.
2 standard deviations is 95%. So what would 2 standard deviations be?
You said 95%?
95.
So
Yep.
190.
No, for the actual returns. Excuse me. So we were
30
at
or 10.
Right.
30,
Exactly.
10. Yeah.
Yep. So now you can expect that your return is going to fall between 2 standard deviations 95% of the time.
Right.
Right. So that's really understand where the level of risk is, because if we can reduce the standard deviation, which also would reduce that average return.
Yeah.
But we can reduce our standard deviation. We can increase our level of confidence to be sure that we can reach the level of retirement that we've always wanted.
And, here's the fun thing about this job is like, and I know you talk about this all the time, but I talk about this with clients all the time. It's like, we have to look at things with a certain lens. We're looking at standard deviation.
Right.
We're looking at beta.
Right.
We're looking at alpha. We're looking at PE ratios.
Yes.
And 99% of people are like, what are you talking about?
I love it. I can talk about it all day, but
Right.
most people, we're talking a different language there.
Yes.
Right.
And so I think that's one of the most important things, though, because I know you've leaned into that. And maybe talk to me a little bit about that when you're going through somebody's portfolio and there's a wild difference from where they want to be and they are.
Yeah.
Are you going into that type of depth?
I do, absolutely.
Okay.
Right. Now, that may not be something that we're going to sit down and talk with clients directly about, because
Right.
like you just said, not everyone has a level of understanding where that's going to make a lot of sense.
Right.
But that's something we absolutely, as advisors,
Right.
need to be going into.
Right.
Right. Because there's a lot of different metrics that you can look at when
Correct.
you're looking at someone's investments, and actually having a good understanding of that to see, again, all of this comes back to risk, how much risk you're actually taking.
Yeah.
Right?
So with those folks, they were, when you first sat down with them, they were 80% equities, AKA stocks. They were 20% bonds, I would assume.
Yep. The rest was 20%, some cash.
Okay. So some cash, some bonds with 20%. Where did they end up landing on their allocation? And again, you don't have to get into too deep in details, but like where did they end up making that shift to get down to where they were comfortable?
Yep. So, and this came down to education as well, right? Because as we started talking more about it, we were able to find that they didn't necessarily need a lot of the investments or being able to generate income from the investments. They had enough through Social Security, and one of them had a pension as well. So then we started talking about what the purpose of those assets was, right, of that investment account.
Great point.
And they didn't necessarily need it.
Yeah.
So it was going to be left to their 2 kids, right? So now you've just increased your timeline, and now we can actually take a little bit of risk in the account to have it grow a little bit more for the benefit of their kids.
Got it.
So really understanding what the purpose of the money is, it's going to help you determine what level of risk you're willing to take.
Oh, I love that.
Yeah. So going back to your question, we actually did not take them down to no risk to completely protect their principal, but we went to closer to 50-50. So that way we could have a more even stream or an even line return,
Right.
but still get a little bit more
Right.
of a return in the long run for the benefit of their children.
And maybe what's some investments, and again, not to put you on the spot, but just ideas, spitballing, again, because just for the record, we can't recommend anything to anybody, right? There's my CYA,
Disclaimer,
right? But until we talk to you, sit down with you, give you a second opinion, understand your needs. And again, that's stuff that Ken's doing all the time. If you're somebody sitting out there right now and you're saying, you know what, is that me? Am I taking more risk than I think I am? Reach out to us. I know Ken's done a ton of different Zoom calls, phone calls. If you're, of course, in the Troy, Michigan area, great. If not, we can take a look at your stuff, give you an analysis, tell you how much you pay in fees, tell you exactly where you're at on that risk spectrum, and give you that education to help you make informed choices.
Right.
So if that's you sitting out there, do not hesitate. Reach out. I can put you in touch with Ken directly, and he's happy to do it. I know.
Absolutely. I love doing this.
I was going to say, if you didn't already figure it out, he loves this stuff.
Yeah.
So that's half the fun for us. So, kind of getting back into it, what were some of the options that you laid out for them to maybe help reduce risk? Whether it's a security, wherever you guys ended up going in that conversation, what were some of the options you laid out?
Yeah, so we have several different investment portfolios that we can choose from here, and generally that is the route that we ended up going.
Okay.
Right, to be able to choose some of our ETF portfolios that we actively manage here at Foguth. But it took a lot of education on that too, right? Because you're talking about someone who'd been sitting in mutual funds and A shares, right? Which I don't even think they really offer in too much anymore now.
Right.
So being able to educate them on the different structures of investments is also important, right? So we ended up going towards some of the models that we manage here, and we're able to use different ones to get to the allocation that we discussed.
Okay.
But there's obviously all kinds of different investments out there.
Yeah.
Right?
I mean, we could take literally
do
2 hours.
We could do a whole nother podcast just on that.
Right, exactly.
So yeah, we ended up choosing that. But again, being able to get them to understand how much more efficient something like an ETF versus some of their old mutual funds was a whole nother education.
And just on that simple one, just, if you're sitting out here listening, you're like, what's the difference between a mutual fund and ETF? How would you explain the difference between a mutual fund and an ETF, Ken, in layman's terms? And what's the easiest way somebody could kind of connect that dot?
So there's a couple of ways that I would like to explain it, but it's really more just an efficient model to have either an active or a passively managed pooled investment vehicle. Right. The way sometimes I like to explain it is it's kind of like Taco Bell.
Okay.
Right. Let's say you go and you get a burrito.
Right.
And it's got meat, cheese, beans in it. Right. And then they package it into a chalupa and it's the same things in it, but it costs more.
Right.
That's a mutual fund. All right. So why not use the more efficient model and still get all the same things in the middle?
Amen.
Right?
I love that. I've not heard that, and I like that a lot.
Yeah. So again, just looking at all the different kinds of investments, it's knowing what you own.
Yeah.
Right.
Yeah. It's knowing those expense ratios. Right. And it's knowing, hey, is this a dividend play? Is this an income play? Is this a growth play?
Exactly.
Is this a fixed rate? Right. And then how do I pay fees?
Exactly. Knowing how you pay fees is important too.
Absolutely.
Right. Because just because you own a mutual fund. Doesn't mean that the fees are all charged the same way.
Correct.
Right? We could get into the share classes of mutual funds and talk about that for another hour.
So what would you recommend? So we've kind of identified, what the risk spectrum is, right? Whether it's 0 to 10 or 0 to 100 and where kind of people fall. And there's no right or wrong.
Yeah.
For the record.
Right.
I've met people, I joke around. I'm like a 9 out of 10, right? I love risk, but I'm 41 and I do this for a living.
Exactly.
And I got a long time still at work.
Right.
I joke around my wife, right? She's like a 2 out of 10.
Yeah.
And she's 35 years old. It's got no business being that, but that's what helps her sleep at night.
Yeah.
And
I see people like that all the time. Right? Where you'll see some younger people that aren't willing to take any risk because guess what? Maybe they grew up during 08, 09 and they saw their parents lose a significant portion of their wealth to the markets.
Right.
And now they're not willing to take any risk.
Right.
So sometimes I need to educate people like that to actually take a little more risk than they're willing to.
Correct.
Right?
Yeah. And so we got the risk spectrums identified. Then we go to the second phase. We say, all right, understand where you're at and verify that it matches up with where you want to be.
Correct.
And then the last piece, you're heading into retirement. What are some general best practices? Because we always say it's almost impossible to generalize.
Yes.
For the record, and we're about to do what we say not to do.
Everyone's individual situation matters.
It does.
And they're all different.
And again, I have clients who are 75 years old and super aggressive.
Yeah.
I also have clients who are 75 and like no risk.
Yep.
There's no right or wrong. It's different situations. Do you have a pension? Do you not? What's your Social Security benefit?
Right.
How much money do you have liquid? Right. All these things come in. What are some general best practices or processes, education that you would encourage folks listening or watching to, if they're considering retirement? What's kind of that window? How far out from retirement? And what's a good process to walk down?
Yeah, to start planning for retirement, obviously the earlier the better.
Yes,
right?
Amen.
But if you are nearing retirement and you think it could be within the next, I'd say 2 to 5 years, then you should absolutely start sitting down with an advisor to determine where you should be and if you're on track.
Okay.
Right. And if at that time you should start maybe lowering your risk.
Right.
Right. Because as you're getting closer to that, that's as you should be taking some risk off the table. Right. Because we're going to need that money for most people to live off of, at least a portion of it. And the last thing you want to do is pull a bunch of money out.
Yeah.
Like we just had in April when the market was off, right? We don't want to sell low.
Right. Amen.
So you definitely want to start actually getting a plan in place and sitting with a professional at least, I'd say, 5 years prior to retiring, in my opinion.
And I agree with that. I
Yeah.
think 5 years is a great window. To your point, sooner the better, because the more time a good advisor, a good fiduciary knows what they're talking about, understands this stuff, the longer they have, the more proactive and better the plan will be, period. But also don't feel you're too late if you're already retired. Right? You're about to retire, next month. It's not too late. There's always something you can do. You retired 5 years ago. There's still a conversation to be had, and there's still education to be gained.
Absolutely.
Yeah.
There's always something that we're able to add value on, right? We don't even need to work with everyone, to be honest.
Absolutely.
But if somebody comes into my office and I can provide value and educate them on something they weren't aware of, I can almost find something with everybody.
Right.
Yeah. And I enjoy doing that.
Yeah.
That's just the truth.
Yeah. The second opinions are some of the funnest things to do. It's funny because, full transparency, Ken and I were doing the podcast today. And so I had a meeting and I was like, hey, let's do this meeting together today. Right. Yeah. And it was interesting because it ended up being just about the subject we were going to talk about.
Yeah.
The gentleman's going to retire in 5-6 years, and he's a more aggressive investor. And that was basically what we spent our time explaining to him is like, and in his specific case, he only needs 4%.
Right. Well, it was basically a perfect case study for what we're talking about.
Yeah. Literally, I think he was 56 years old. He's going to retire in 5 years, give or take. He only needs like $3,000-$4,000.
Yes.
I showed him if you just got 4% the rest of your life.
Yeah, I think it was 4.06%.
Yeah, 4.06. Yeah. You're going to pass away at 90 with $4 million.
Right.
And he was mind blown.
Yeah.
And that's the whole thing. Like, if you only got 4% the rest of your life, you live comfortably.
Is $4 million enough?
Is $4 million good? I don't, and he was mind blown.
Right.
And the whole message that Ken and I were giving him was, it's okay to reduce your risk, because he was coming from the frame of mind of, I still have to catch up. Right. I still have to make more money. And that's the power of education, of math doesn't lie. And if you lean into the math and you sit down with the right people and they can forecast, income planning, right?
That's huge.
It bleeds right into it. But what would be some best practices, kind of to throw out to people to, make sure they're not getting taken advantage of, make sure people are in a good position.
Yeah. Well, there's a lot of different ways in which advisors can be licensed, which they can actually be registered, who they're registered with, right? So first, you want to just make sure that you sit down with someone, and trust is one of the most important things.
Absolutely.
Right? If you don't trust whom you're working with, then it's probably time to look elsewhere. Okay. We're in the business of managing people's money, and trust is definitely the most important thing that you can do. But best practices when you're looking at an advisor, you can interview multiple. I have no problem when people tell me they're doing that. I say you should, right? Go get another opinion, right? If you've been working with someone for long enough and you haven't had another opinion in 10 years, that's time to probably go look.
Yeah.
Right. And again, I don't like to bash on the industry or any other advisor in general, but it is an aging profession.
Yes.
Okay. And I see that all the time where people that I'm working with, their advisor is maybe an older gentleman or woman or entering retirement. And with how much the industry has changed in the last 15 years alone, it's probably time to get another opinion, because just like we talked about with, different types of investments, mutual funds versus ETFs, the way in which you're charged fees, things have changed significantly.
100%. Yeah. I even told a funny story on that. You're like, listen, I encourage people to do it.
Yeah.
My mom retired. I said, Mom, she's like, well, obviously I'm managing my mother's money.
Of course.
And she's like, well, Alex, I just, I'm good. I was like, well, my mom, go out,
look, see what else is out there.
Get some education. You might learn something new. Like, it's all good. And, obviously she stayed with me, and I'm continuing to manage her money, but it was a good thing for her because she did learn some stuff. And she said, you know what, thank you for encouraging me to do that. Just because I was able to learn a couple things that I hadn't known.
Exactly.
Because she's just like, oh, Alex has got it. And she might not be asking the same questions that she would ask a stranger. Right. Which is, that's okay.
Yeah.
And so anything else you would add kind of before I, kind of go through the bullets here?
For somebody that's entering retirement and looking at hiring advice.
Best practices, how to make sure they're in a good spot and they're getting the education.
So the most important thing, and I do consider this to be the most important thing, and every one of my clients gets an extremely detailed retirement plan. right? You need to have that. You need to have the details actually entered in there as accurate as you possibly can, right? Do some budgeting, know exactly how much you're going to be spending. So that way we can put that in there because based off of, the software that we have, which is phenomenal, we can run some really deep analysis to determine with a high level of confidence where you're going to be 10, 20, 30 years from now, right? So get that done if you're entering retirement, because if you're not on track, you need to talk to someone like us who can help put you on track.
Amen. I love that. And I know Ken didn't even get into it, but from tax planning.
Oh,
that's,
yeah.
I mean, obviously.
Taxes are, I consider it a given part of everything we do, right?
But the tax planning, the risk spectrum, the investments, the fees, the income, running out of money and all that. So these are all important things. So thank you, Ken. So, main points. Number one, understand the risk spectrum, right? Understand, how do you identify where you're at on it? We have like a survey. So also if you're sitting out there like, I don't know where I sit, we have a 15-question survey we send to our clients and prospective clients we do second opinions for. So if that's something you're interested, we're happy to send that to you. Just reach out to us and we're happy to send that to you. Again, Ken can even walk you through
happy to.
What that looks like pertaining to, hey, where am I at? Where should be, right? That second piece is once you understand that risk spectrum, where are you on it now and where do you want to be? That is a very important delineation. If there is a big delineation, the question should be, well, how do I get to where I want to be? And again, this is all part of our educational process that we do. Now, whether it's us or somebody that you trust, it's all good. But the main point is we want to encourage you. This is something that we do complimentary. This doesn't have any cost to folks. But if you're looking to understand where you're at on that risk spectrum, do your investments match it? And what type of changes can you or should you make? This is what we're really talking about. So when we talk about measuring risk, right, that's what we're talking about. So Ken,
that's right.
Anything else you would like to add before we kind of wrap up?
No, I mean, it really just just to summarize as well, it comes down to knowing how much risk you're taking, knowing what you own from an investment perspective and going from there.
Yeah, well, thank you. Thank you, Ken, for joining me today, man. It's always a pleasure.
Yeah, you as well.
And I always love getting you down here and hanging out. So thank you so much to all you listeners out there. I hope you're enjoying this. I hope you're continuing to get some good pieces. You listen to one of these and you walk away with one thing, that's a win for us. Again, peace and purpose for your money. That's our whole objective as an advisor team and as a firm. But I can't say it enough. If you're enjoying this, you're learning things, send it to your friends, send it to your family, send it to somebody who you might think would benefit from this. Make sure you're liking and following us. And I can't say it enough, but if you're interested in one of these complimentary, you just have a simple question. Please do not hesitate to reach out to us and engage with us, whether it's a message, an email, a phone call to our office. It's all good. So again, I am Alexander Pushman, your host. Thank you for joining us, Real World Retirement, the podcast, and we'll see you next time. And again, if you have anything you need, you let us know, and we'll see you next time. Thanks so much.
Advisory services provided by Foguth Wealth Management, LLC, an SEC-registered investment advisor. For additional information, visit advisorinfo.sec.gov and search 327434.